All right. So in this video, we're going to look at the different types of risk and a few risk definitions. So we have first on our menu, we have pure risk and speculative risk. Pure risk involves a possibility of a loss. So you could have no loss or you could have a loss. And those are the only outcomes. The question, of course, would be the probability associated with the losses and the magnitudes. But it's no loss or the possibility of a loss. We also have speculative risk, in which we have the possibility of no loss, possibility of loss, but also the possibility of gain. So in that case, it's a speculative risk because you could actually gain from it potentially. An example of that would perhaps be investing in the stock market, where you could lose or you could stay the same, but you might also gain. So that would be more of a speculative risk. There is also something known as subjective risk. Subjective risk is basically the perception of risk that you have. So for instance, you may assess the likelihood of your home burning down as being some percentage. However, statistically, it may be very, very different. Sometimes people have very incorrect assumptions about the likelihood of getting various diseases or getting in car accidents, their home burning down, or so forth. So subjective risk would be essentially related to that perception of the probability of a loss event occurring. Now, if we look at an insurer, so like an insurance company, for instance, there can be a gap between what they think is going to occur going forward and what actually happens. So that's called objective risk. So if they think that they're going to perhaps have a certain probability of a certain amount of losses due to insurable events, such as homes burning down, property being stolen, car accidents, etc., depending upon the type of insurance. If more losses actually occur than what were expected, that gap is what's called objective risk. Now, if you are looking for an example of that, an example of that would be kind of like what happens if you flip a coin. So if you have a fair coin and you flip it, you would expect that it'd be 50% chance heads or 50% chance of tails. Well, if you only flip it, say 5 times, well, you can get 1 head, you get 2 heads, 3 heads, 4 heads, 5 heads. You get any combination there. So let's say you get 3 heads and 2 tails. Well, that's not a 50-50 split. If you flip it another 5 times, you're going to get some other combination. If you do another 5 times and another 5 times, let's say you ultimately flip that coin 1,000 times. Well, the more times you flip it, in aggregate, if it's a fair coin, then what should happen is over time, the overall average should work out to 50% heads, 50% tails. So if you are an insurer, insuring a large group basically means that the probability tends to win out in the end, so that if there's a 2% chance of homes burning down, if I am looking at thousands of homes, probably that 2% is going to be pretty close to accurate. If I just look at 5 homes, it can be rather off, because if one house burns down, we're up to 20%, right? So from that standpoint, objective risk is basically that gap between what's expected and what actually occurs. And the bigger the pool of insurance, the smaller that gap should actually be. Fundamental risk is a risk that would affect a large area or a large swath of insurance policies at once. For instance, homeowners insurance and an earthquake. So if you have an earthquake, it hits a whole geographic area all at once. So that would be a fundamental risk. And that does not work real well typically for insurance companies, because the whole idea behind the insurance model, if you go back to the first video in the series, is that there's a chance that there could be some losses, say one house burns down out of 100, something like that, right? There's a chance of losses. Well, if I have something like an earthquake, it could hit the entire group of houses I insured if I'm the insurance company. So that obviously causes problems, because the insurance company doesn't have nearly enough money to pay for all the houses they insured, period. The whole idea behind the insurance model is everybody pays in. That money is enough to pay for the limited number that actually experienced losses, and we kind of go on to next year. So if we have a large fundamental risk, like an earthquake or high risks of wildfires or something like that, that really could affect a huge swath of homes, that could be a very significant problem for insurance companies. Another example would be hurricanes and flooding and things like that. Typically if you have a flood, it's not a localized event that just hits one house. Normally we're talking a flood, it's a much bigger event. And so often that can be challenging for insurance companies, and sometimes governments have subsidized insurance companies that have offered coverage that is related to significant fundamental risk. So subsidizing flood insurance or subsidizing insurance for perhaps earthquakes or something like that. A particular risk would affect sort of one person or one thing at a time. So and that's typically the idea behind like the typical house fire or something that burns a house down. Unless we're talking a wildfire kind of event, oftentimes you have typically one house that burns down, and that doesn't mean that the houses near it are necessarily burned down. And so those are sort of uncorrelated risks, and therefore the insurance model can work. Basically because the insurance company can insure thousands of homes, only maybe one or two burn down, doesn't affect the others. The money that's paid in premiums can pay for the losses of the one or two that burn down. That's kind of the idea, right? It's also important to note that there's a difference between non-financial risk and financial risk. So the non-financial risks would be related to losses of things that can't be quantified in a financial sense. So for let's say you had some artwork created by your children or something that has a lot of sentimental value. It has no recognized financial value, right? And so as a result, you can't really get an insurance policy that's really going to compensate you really very effectively for that, because it doesn't really have any recognized financial value. Sure may mean something to you, but it doesn't really have a recognized financial value. On the other hand, if I'm looking at let's say a car or a home or something like that, there can be an actual recognized financial value. And as a result of that, you can actually have a policy that is written to protect you from the losses associated with that. Now, importantly, it doesn't prevent the loss from happening. It just shields you from the effects of the loss. All right, so those are some types of risks and a few risk definitions. Hopefully that's helpful. And I'll pick up with some other topics in the next video. Have a great day.